Actually, Sourceman here. It's December 1st, 2022. I'll talk a bit about a few concepts which I think are important in this video. And just again, like I try to hammer in how I think one should go about to beat the market by simply playing a totally different game than what everyone else is doing. Basically, taking advantage of the fact that 95% or more people pretty much are driven by the same things. They do the same motivations. They focus on the short term. They're emotional. They try to, in my opinion, look for too many factors that plays into their investing decisions, which I think is a total waste of time. I think again, it's like with any game. I mean, you're supposed to collect as many edges as you can because that obviously builds on itself. So if like you see on Twitter or whatever, it's like everybody's kind of focusing on the same thing. I mean, you have a bunch of shortists who think technical analysis is the most important thing, and everybody's trying to again right now, I mean, what is the topic of discussion typically? Is the bottom in? Are we in a bull market? Are we in a bear market? And stuff like that. I mean, to me as a stock picker, I mean, that's totally irrelevant. You want to pick companies that you believe have good risk reward and where let's say the company fundamentals are in a bull market, or at least are incredibly cheap, for example, because this sector or no sector stays extremely expensive or extremely cheap forever. That's just not how it works. It's like the crypto sector became more expensive. Well, it's like absurdly expensive. But one day that stopped and it became cheaper, and you can see that in tech and all of those things. And for the commodity sector or any cyclical sector, I mean, they are called cyclical sectors because they are cyclical. I mean, all you really need to do in that case is just understand that you basically are playing Pong, and it's driven by human emotions. Greed to fear, to greed to fear, to greed to fear, forever and ever. And the worse a sector gets, I mean, like Rick Rule says, a bear market is the author of a bull market, and a bull market is the author of a bear market. That's just how it is. I mean, it's really simple from that perspective. It's just that we make it super hard by, in my opinion, focusing on the short term and then letting a bunch of noise affect us. And the hard part is that goes for almost everyone. So the market on a short-term basis is driven by said noise and becomes noisy. So you can't escape the effects of noise even if you turn a deaf ear to said noise. It's just that you have to constantly basically ignore what everyone else is focusing on, because there's no edge there. But I just plotted down some concepts. Like I just said, I mean, the typical thing, you see this all the time. It's like, shortist or whatever. It's like gold silver ratio. Everybody's trying to figure out, are we in a bull or a bear market? Is the bottom in? I mean, that's literally what most people are trying to find at when the sector is cheap. Any sector is cheap. When is the bottom in? Because that's, again, it's driven by the fact that nobody wants to risk a short-term loss. Anyone if the trend is down and a company is valued at X, they are not inclined to buy because they don't think, or they believe it can go down tomorrow. So why would I buy something that I believe can get cheaper tomorrow? So that's why nobody ever buys really cheap levels, because you never know when the bottom is in. I mean, if I look at some juniors out there, for example, some are off, let's say 50 to 80% from their July lows. But on the from a bigger scale, people are not even convinced that the bull market in miners or gold and silver has started. So in that case, if you just bought all the way when something went from extremely cheap to absurdly cheap, and you just bought, from the lows that would be up 80%, while most people are still debating if you are in a bull or bear market. And that changes. If we see an update, people get bullish because they think, hey, the bull is on. If it goes down, oh, Jesus, it's, the bear market is not over. And you typically, it's like silver, for example. I mean, it's so volatile. It's like if it's up one day, or at least the recent months, it's like you can almost be assured it's going to be down the next day. And if it's down the next day, it's going to be up the next day after that. So, I mean, one would pretty much, to calm one's nerves, it's like, okay, it's up today. I expect it to go down tomorrow. So you won't be surprised or throw a fit or like, oh, I did a mistake. But like I've shown before, it's like everything gets solved by simply buying low, and or buying cheap, I shouldn't say low, buying cheap, and if it gets cheaper, you just buy more. I mean, that's literally the easiest way to just beat the market. So again, my answer to, are we in a bull or bear market? I don't care. And that goes also to stock picking. It's like if there's a great project with probable growth, for example. I mean, if you believe that deposit or system is going to grow, I don't know, 200% over the next 2-3 years, that is a bull market in fundamentals. So even if you have the exact same sentiment levels, pretty much, I mean, they're going to have a lot more gold or silver or whatever. So even if the sentiment levels are the same and a gold ounce in the ground is valued at $20 per ounce, if you have 3 times the amount of ounces, that's still going to be more highly valued by Mr. Market, because if it's not, I mean, then it might require to price in, let's say what is that, let's say $6.7 per ounce. That means that in that case sentiment actually has to get worse for you not to be sitting on a profit in your share, let's say. But that is not accounting for dilution, etc. But still, I hope my point comes across. It's like people at the same sentiment level, people are prepared to pay more, obviously, for 3 million ounces than 1 million ounces. For 1 million ounces to be priced the same as 3 million ounces, the sentiment in the 3 million ounce scenario, future scenario, must be considerably worse. And we're already at, abyss levels of sentiment. And of course, what happens when this sector inevitably turns? You're gonna make a lot of money. And the question is not if, it's more of a matter of when. And this, I've seen this stuff. I mean, people post stuff like this in the forums. It's worthless to release results in December. Why? Because they don't get any immediate gratification. And that's why I talk about, the game is rigged. The game is pretty much rigged for a holder. Because if you own a cheap company, releases good results, market doesn't care. Okay? You took on assay risk. Let's say you held a stock going into assays. I mean, we saw that, for example, in Goliath. Yesterday, released news, assay results. There were some good hits, some bad hits, etc. I mean, it's early stage, wide space exploration drilling. You're not supposed to hit, super hits in every hole if you step out like that. I mean, they're basically trying to prove up the footprint. But okay, those were. I mean, the case, in my opinion, is very much intact. Still, you get hit if you're a holder. But like in many cases, or let's say might be a better example. Let's say the news was great, it's a discovery, whatever, and the market doesn't care. So you take on risk, because if the results were negative, let's say, regardless of how cheap a company is on an absolute basis, it would go down because the news was negative. Nobody's thinking really on well, I'm going to get to that later. I'm going off track right now. The main point is that, yes, for a holder, it's rigged against us in the short term right now, because negative news gets punished way more than positive news gives us benefit, despite the fact that many companies are so cheap already that they already priced in, let's say, negative news. If it starts at a very cheap level and it's already priced for failure, and some bad negative news might not even, be company destroying or anything like that, but just, below expectations, whatever. Just enough that no new buyers are willing to take risk and buy the stock. And right now we're in tax loss selling season, yada yada. So there's a bunch of stuff. I mean, at the end of a 2-year bear market, everybody's looking for most people barely hang on right now. Most people, I think, have sold out actually. So it's incredibly skewed to the downside. But at the same time, okay, how do you flip that? Okay, if it's rigged against us bulls in the short term, meaning that there's a negative skew or bias to how the market receives news. For the holder, that's bad. For a buyer, that's superb. Because you can literally buy success for free with no risk. It's almost like being an insider in hindsight, because insiders don't take any risk. I mean, we're talking about, if you have inside information, you don't take any risk because you know what the results are going to be. So you already know what you're buying into, you're front running a news item, what it's going to be. In this type of sentiment environment, it's almost like you're an insider, because if positive news comes out and that doesn't get rewarded really, I mean, it's like buying it, buying news, positive news, again, without taking any risk, like the insider. He knew the news was going to be good, but okay, in this market environment, it wasn't really, any benefit to him short term, because nobody cares anyway in this sentiment environment. But if you can buy after the fact without paying up, I mean, it's basically the same as being an insider, simply because nobody cares. So I mean, that's why I keep saying, it's like buying right now, in my opinion, is exponentially better than holding, and holding is exponentially better than selling. So right now, I mean, think about how much you can tighten up the quality of your portfolio, let's say. There are companies out there with discoveries or news, as a result, the case is intact, it's growing, etc. Barely, any price change at all. You can buy a considerable amount of de-risked success, again, after the fact, without taking any risks, despite the fact that you don't even need to pay up for it. So it's like that is a lot more. Not only are these levels cheap, you can buy a lot of stuff without even taking risk. You can buy after the fact, because if you're going into ASI results, you don't know what the ASI results are going to be. That's risk. And in this market, again, it's like skewed to the downside for a holder, because the news needs to be really good for the market to care right now in tax loss selling season. But if you're a buyer, that's extremely favorable, because you're already starting off from very cheap levels, and you can buy even more value after the fact, after you actually see what the hand was. I mean, it's like, the cards get turned face up, you see the news, the price of the company doesn't change really, so you can make a more informative, I don't know if that's the word, but you're better informed, but the price to play the hand doesn't change. If there's a good hand that gets turned up from a news release, okay, you see obviously the risk-adjusted value of this company went up, but price did not. That means it's a much better buy because Mr. Market didn't respond at all yet. And again, value shuffling, I mean, that's pretty much on that point. If you own, let's say, 10 companies and you see similar risk reward, so let's just pretend here that you have 10% in each company. You think the risk reward is the same for all. And then you have some news trickling in. One company releases positive news that is worth 30% of the current, cheap enterprise value, but the stock responds with plus 5%. So if you believe Mr. Market in the short term, not much changed at all. I mean, 5%, let's say it comes off from a cheap level, that is probably nothing, I mean, in terms of dollar value. But if that news was actually material to the tune of 30%, I mean, the case changed, the risk reward in that particular stock changed dramatically. Who knows, maybe it became 200% better than the 9 other companies. And then you can do, value shuffling. So even though, again, it's like from a short-term portfolio perspective, the only thing you saw happen was that one of your 10 companies went up 5%, which is 0.5% added to your total portfolio returns, assuming the other ones were neutral. That doesn't look like much at all. It's like, why even bother? Nothing changed, yada, yada, yada. But it has huge implications for your longer term results, because that case suddenly became a lot better. Future expected returns, who knows, maybe went up 100%. Or the probability of future returns went up, that it de-risked the actual story, let's say. Maybe Blue Sky didn't increase so much, but it got highly de-risked. So again, it's like on surface, nothing happened for your portfolio except a 0.5% bump. But a huge opportunity just opened up for you because the market didn't care. So all of a sudden you can buy, let's say, a case for 5% more when the value of the case went up, let's say, 30%, and the relative risk reward versus your other stocks, maybe that stock alone became 200% a 200% better buy. So everything is about a future that has not yet happened, and we use how the market works short term. Right now it's, again, not discounting positive news and over-punishing negative news. That is how it works. That is what people are complaining about, but they stop there. They just complain about it. I mean, there's no point in complaining about it. Our job is to figure out, how can I use this sentiment, how the market works right now in the short term, to my advantage. That is the edge. Mr. Market is your opponent. So if he acts in one way right now, our job is to figure out how I can turn that against him. And again, long term at some point becomes short term. And sentiment always changes, which everyone, including Mr. Market, forgets at every top and every bottom. Because nobody would be buying absurdly overvalued stocks if they didn't think, hey, this might be a good idea. And nobody would be selling now if they thought, hey, this might continue forever. We know it doesn't continue forever. And that's why we're supposed to buy very cheap levels. Because it always changes. But the market, Mr. Market, always forgets that. short term, the market might be very efficient but totally clueless from a long-term perspective. That's basically what I said. Because again, it's like, yes, negative news comes out, a stock responds negatively. That's not irrational. Positive news comes out, a stock responds positively. That's not irrational. Now, however, there's a big skew towards the downside, risk off. Everybody's the focus of everybody at bottoms is to not lose more money. They don't even consider what you should be actually focusing on, how I'm going to make the most money when things change. And also, one thing is that, like I highlighted here, negative positive news with bias gets discounted in the short term on a skewed and relative basis. Because again, if it doesn't matter how cheap, almost right now at least, how cheap a company already is. If there's negative news, and it doesn't even need to be material, something, whatever really, or a worry, it's like, hey, I think these are gonna need to bring in money soon. And there's no end to how hard a story can get discounted like that. Because, I mean, think of it, it's like the never-ending carrot. If you know a company is gonna need to raise money to do more work, if it goes down, that doesn't change the fact that they're gonna need more money. So the market really believes or thinks that there's no reason to buy this until they raise money. So until they raise money, there's a permanent, let's say, skew to the downside, because everybody's fearing the dilution. It doesn't matter if it's like, I mean, some juniors right now, if they diluted 100%, raised their entire market caps, they would still be cheap. So in my opinion, that's like, again, fearing something that, let's say you have a very cheap story. In my opinion, a good example would be District Metals, because yes, they basically halted most of their work. They're preserving cash. That had a market cap recently of like 4.3 million. They had like, I guess maybe sub 1 million in cash, but that's still absurdly cheap. So it's like, if that were to double, if they raised the entire amount, 100% dilution, that would still be cheap. But it's never cheap enough for the short-term oriented market, which sees some dilution, which is a scary word, coming on, because they know it's going to happen. That's like if that's the same almost with hyped up exploration stories. If let's say a hole comes out, or visuals from a hole, it's like, visible gold. Everybody expects that the hole is going to be good. And let's say it take 2 months for that hole to actually come out. Everybody knows that hole is going to probably be good. So everybody thinks, well, regardless of when the hole comes, the assay results comes, I'm going to get a bump. So you have 2 months for people to front run the quote sure positive thing. And what typically happens after that is obviously everybody has piled in already, because everybody is expecting the same thing. Everybody's sure the hole is going to be great, the hole is going to be great, the hole is going to be great. Positive news is coming, positive news is coming, positive news is coming. So you can have these incredible ramps, and then everybody's in already. And it can go way past, let's say, risk adjusted, even long-term value, even in this, well, maybe not in this market. But then it, let's say, crashes. So I think, for example, in some of these companies that have crashed now because there's been this negative carrot in front of the market, because everybody knows they're gonna take in money. So everybody agrees that there's gonna be dilution coming, and everybody agrees that you don't buy into a company when there's dilution coming. But I would bet that when this dilution actually happens, that is like, I mean, it's gonna jump pretty bigly, let's say, because most of them shouldn't even go down that much from dilution fears anyway. I think it is actually the same for like Western Alaska. Yes, there's a quiet period, winter months, that have already started. They're going to raise money because they're going to have a very ambitious 2023 field season. One of the best exploration stories out there. Silver was up 4.6% yesterday. Western Alaska ended slightly down. Why? Obviously, in my opinion, because people, maybe some tax loss selling, who knows. But it's like, that is, in my opinion, incredibly cheap based on what I think that district is going to produce from, exploration results going forward. But what is the main driver in the short term is, again, that I people know, hey, if they're going to be this aggressive, they're going to raise money. So that alone is like, hey, why should I buy this? And to me, it's like, who cares what well, kinda. From a long-term perspective, I don't care if I pay 20% or 20% less, 20% more or 20% less than now. If the dilution is 10 or 20%, for example, I mean, that's details from a longer-term perspective. And if the market agreed with me, it wouldn't be this cheap, obviously. But I'm not willing to part ways with companies just because I think that the Mr. Market can get more stupid, because that's what everyone else is doing. And one day you're gonna be left there. It's like, yeah, I knew this was like a super cheap, but I was convinced, like everyone else, that hey, I mean, they're gonna raise money, and that's always bad, right? But it's just enough sometimes for one serious buyer to realize that, hey, I mean, this is too cheap already, even with dilution, yada yada. This is, an obvious buy. So it's like, yes, this market is so stupid right now that that might work, but that's greed to me. It's like you're not, let's say, buying or selling a no-brainer because you think a no-brainer can get even more no-brainer. I don't think that's required to beat this market. To, again, or never ever having the risk of a short-term loss. That's what gets people, in my opinion. That's why they always end up buying high short-term and selling low short-term, because any day a stock is up, I am like that too. If a story I like is going up on any day, I get FOMO. If it goes down, I get fearful. It's just that, because again, it's like, it's for some reason our natural instinct is like, trying to predict what's going to happen tomorrow. But then I again just take a step back. What does it matter what happened on December 1st, 2022, if I think this is going to be a obvious world-class project in, it's going to be obvious that it is a world-class project in 1-2 years. We're talking again like picking up pennies in front of a steamroller. It's certainly not that which is the main driver if you beat this market or not. So again, it's like, in my opinion, short term, there's no edge really. There's no edge in trying to outsmart the market short term, because the market, first of all, isn't rational on a short term basis. And what is obvious to everyone's like, yeah, this is going to be a great haul, blah, blah, blah. There's no edge there. But there's an edge in, again, seeing news and then putting that relative to the long-term case you have. Because if something is cheap, let's say negative or below expectations news comes out, it will get punished regardless of how cheap it is from a long-term basis. So some companies with, let's call it negative news. When they drop big, especially at a time like this, the risk reward in those cases might go up considerably. But most people just look at the short term, just that news release, and see the reaction by Mr. Market and think, yeah, this stock is bad. But they don't pay much attention to the fact, well, this news release isn't going to stop the next 10 to 20 news releases that on average are probably going to be good. And if that turns out to be true, the current price, especially after this dip, is incredibly cheap. So the risk reward just went up. So that is also, how you, in my opinion, it's like you should use the volatility. That is how, again, you use what the market does in the short term, because the market is pricing in short term. And now it's even pricing in a short term with a skew. That means that good news doesn't get discounted enough. That's an edge. Bad news gets overpunished. That's also an edge or an opportunity. And all of those things should come back to, again, the long-term opportunity, because short-term, there's no point in trying to get everything right. It's like I say about this chart here. This says absolutely nothing about tomorrow or next day. Sometimes not even much about the next 6 months. But it says everything about what's probably going to happen within 2 years. I mean, think about it. How easy isn't this sector really when you just look at a chart like this? And again, don't try to predict anything about tomorrow, next week, or next month. Then this, one could say, is one of the easiest markets in the sectors in the world, I would say. But all opinions you see out there are always based on the short term. And there's always a bunch of other noise, like people trying to guess what the Fed is going to do, where rates are going, inflation, yada, yada, yada. That doesn't matter, obviously. It goes from expensive to cheap, and it's going to go back to expensive. As soon as a trend forms, people are going to do what they always do. If it goes up, they're going to buy more. If it goes down, they're going to sell more. This becomes a self-fulfilling prophecy. It's like when a trend has formed, first of all, long downtrend, okay, everybody wants to sell. Everybody wants to sell cheap, like always. Then one day we have a bottom. This might actually, I think this is the bottom, given that gold is at, 1800 whatever. And the juniors are absurdly cheap. So one day, we don't know when, but there's going to be enough of an uptrend that people are going to feel comfortable paying higher prices, because they're, again, guessing where it's going to go in the short term. This was obviously a way worse buy than here. But a lot more people feel much more comfortable buying this because they've seen this happen. A lot of people, let's say, semi-new followers of mine, they got in here. Why? Because they saw this and predicted this. But I again, it's like you pretty much can't lose. And there's going to be a bunch of, stocks that go, don't turn out well. This is a very brutal business. But if we only focus on this longer term, again, how do you use this chart? Because this is like basically a greed fear chart for the junior mining sector. We would say, or I would say, it's like we're here now. We were down here. We're up a bit, yes. But still, if the sector goes up or down on any given day, people are gonna try to guess what tomorrow is gonna bring. You see the same thing on Twitter. If metals are down, everybody's complaining. If metals are up, everybody's thinking how rich they're gonna be. And I have people messaging me, let's say a few weeks ago, they're like, yeah, miners are shit, this sector is crap. A few weeks of an uptrend, same people ask me, what miners should I buy? What changed? I mean, they weren't willing to buy them here, for example, because that was a downtrend. Now they're willing to buy. What's the big difference here? Nothing except recent past and what they think future is gonna bring. And I believe we're gonna get to this sentiment level again, or I'm pretty much 99% sure, or that's one could say it's pretty much a certainty because that's how cyclical sectors work. But I have no idea how the way there is gonna be. I'm just sitting. I'm waiting for this. I'm waiting for the big payday. And anytime pretty much I do short-term guessing, let's say a stock is up, so I get even more bullish and buy it just from FOMO, and nothing changed for the case except the price is gone up one day, and I think, oh, this is running away. Those trades typically do not end up well in the short term. But what saves me is like, yes, if I'm actually right about if the case is good long term, it doesn't really matter anyway. If I pay 10% more than I paid yesterday, it's just yes, I will have lower returns. But it's always the sitting put and hodling that bails me out. My short term guessing where a stock is going to go tomorrow or next week is like really bad. It's always it's like I can make a lot of mistakes short term, I think, if I just continue. That's why I'm fully invested. That's basically to protect myself, because I also do short term mistakes or get FOMO or fear, whatever. But as long as I'm actually in the sector, hopefully this big macro trend here over 2 years is going to bail me out from my short-term mistakes. It's like you absolutely do not have to be perfect. But the biggest mistake I think people do here is like they are not even willing to play. And if they do play, they end up maybe taking profits too early or getting thrown off because, let's say, next 2 weeks we have units are down 20%. So they think, well, this wasn't the bottom, and then they sell out, and maybe then it goes up again. No, so what I'm saying is like I'm firmly planting my feet and just saying this is where it's time to take, especially in beta stocks at least, a lot of profits. But we're not even close to that. So in the meantime, that's my base case basically. We're gonna get to this point, sentiment-wise. And that might take 1-2 years. So all I can do is sit on my ass and just try to pick the best companies that hopefully will also have created the most amount of value when we reach this. Because again, it's like if this is good for a 200-300% swing from sentiment alone, if they add 200-300% value over that time, hey, that might be a 10-bagger. And you don't need many of those to have very good returns. Again, the market average is 8-9% per year. And I just want to touch on, I get asked about my portfolio because I don't update it that much. And the reason for this is mostly because I have a lot of companies that I entered via private placements. So I am willing to buy stocks that are not my top conviction picks, let's say, because I get the added bonus of a warrant. And that's I've been getting into a bunch of private placements all the way down here, and recently as well, last week as well. Because let's say you buy into private placements here, and you have a average strike price from these private placements here for the warrants. And let's say there's a 2-year time rise. When this sector crosses this line, those companies are going to my position in those companies are going to get supercharged because warrants will start to kick in. But some of those companies, if I didn't get at least a full warrant, some actually I think are quite good, so I'm okay with half a warrant. but I might not, have invested in them if not for the fact that I get warrants. So again, it's like, yes, if we're down here, obviously this is where you would want to be in private placements, because this sector doesn't stay this cheap. And if you went, let's say, all in with warrants in a bunch, almost whatever, junior down here, if this is a 600% move for the sector, you might get, I don't know, let's say at least 1,000% from all the warrants, etc. in total. Up here, buying into private placements because you get warrants, I mean, that's not the best idea, because these are overvalued levels, and the odds are that within 2 years it's going to be down. So if the strike price of the warrants are up here, you're probably not going to make any money unless it's a very good exploration story, let's say. But point is that I have a bunch of positions, let's say, that I got into because there was a private placement. And if you were not in that exact private placement, whatever, that doesn't translate well to anyone else. Because let's say, for example, it has grown into quite a big position. What's the Outcrop Silver? I mean, that looked like a pretty solid case, even though it's in Colombia. But it's like, yeah, okay, even for a silver, it's high-grade silver, etc. I got into a private placements with full warrants. Might even be 2-3 year warrants. I'm not 100% sure. But that was the kicker. And now I'm still in a holding period for that. That has grown into a pretty big position. But if someone asks me like, okay, what's your portfolio? And I, show that, hey, Outcrop Silver is one of my larger positions. That might get them to like, oh, he loves Outcrop Silver. No, I got in mostly because of the full warrants, because I knew that this sector was absurdly cheap. And I can't even sell that stock yet. Now I think that looks like a legit story, but I don't know it too well. But you get my points. Like if I show just my overall portfolio, I don't think that's very helpful to people. That's why I added at least the top 10 of the HODL portfolios, what it looks like right now. And there are more companies, but it's like, and this changes, of course, because I use volatility. It's like I slightly added some Goliath yesterday in some of the portfolios, including this one, I think. And Montage is a quite new holding. But at the same time, and that's why I also don't like to talk about what I'm selling, because since I'm fully invested, whatever I'm selling is not a company I'm bearish on. But let's say Snowline doubles from here on really good results, so it doesn't really become expensive, but the position is too large. So I sell this, and let's say I buy Western Alaska. If I'm selling, and it's like, yeah, I'm selling Snowline, that's not a sell rec, if you know what I mean, even though I don't, do buy or sell recs at all. It's just that, hey, that position got too big. But if I, he's a seller. Yeah, but if I had 1% in Snowline, I wouldn't be a seller. So everything is relative from that. That's why I think it's very hard to let's put it like this. I could say every stock I own, for example, or any position, but that wouldn't be helpful. And that's why I added this. Like, note that this doesn't necessarily mean there are 10 risk-reward cases that I know of currently. Because if people look at, my personal, which again is like driven a lot or influenced a lot by what private placement deals I get, people might get the idea that, hey, if this is a top 10 position, that must be top 10 best risk-reward that he knows of. But that isn't necessarily the case. But these are some I think are like pretty good HODL positions, and the HODL folio has done very well. I mean, after yesterday, it's up 32.82% for the year. And I think, I mean, over this time frame, I think 3-year time frame, I think GDXJ is down 9% or 6%. So I mean, that it's absolutely been slaughtering the GDXJ, even though this is a junior heavy portfolio, and juniors have, had an even worse time. And again, this portfolio has had a lot of, minus 80% stuff. Typically, those were not large positions. So that's why at least, pick the, let's say, top 10 conviction plays from a long-term perspective. Because again, this is a HODL portfolio, which I manage for a family member. So I don't want to need to trade. And I mean, the cases are quite simple. It's like Magna Mining, dirt cheap right now. Absolutely dirt cheap. It's de-risked, and I obviously have a different risk profile for these portfolios. Superb team. They are going to try to grow Magna Mining into a mid-tier nickel producer. So the case might be, I mean, they might be growing 3-4 years from now. Who knows? Certainly not I mean, the edge in this is not trading, because the edge is the management team. And the only way to capture the alpha of a management team is to hold the stock. Time is the only way to capture the alpha in the form of a good management team. So why would I trade that? I might as well trade some shitco or whatever. Because, I mean, a bad management team, then time is against you, because bad management teams are going to screw things up and create problems. A good management team is going to solve problems and create value. So time is really the only way to capture that. That's why they are so good at HODL cases. Snowline Golds, might be a tier 1 discovery, absolutely huge pipeline of projects that might be growing in 3-4 years. And I mean, that might be growing in 20 years, who knows. And recently the Lundins went into Fireweed Zinc, which is pretty close by. So now this area is going to be heating up. I-80 Gold, one of the most de-risked, advanced, top-tier gold exploration development stories, and they just hit a CRD system. I mean, they have a plan of being a 450,000 ounce producer within 2-3 years or something. So that's a 2-3 year long case. Basically HODL. I mean, I expect all of these to be up within 2-3 years. And I don't see anything really right now that might, Tectonic Metals, they're going to do metallurgy, etc. But it's like, hey, who knows what Tectonic could become. Their flat gold project the footprint is huge. They're not expensive, yada yada. Goliath Resources, even with the dip yesterday, minus 20%. But is the long-term case over? Is that not a mine? I mean, what's the market cap? 75 million Canadian? I think that's cheap from a long-term basis. I think this has a fair shot of actually becoming a solid mine. Then 75 million Canadian doesn't come close. Western Alaska, huge exploration potential. Gonna have 5 drill rigs working. It's insiders own a ton of stock. Great management team as well. I mean, I would be surprised if Western Alaska hadn't created a lot more value over the next 2-3 years. And relative to the current market cap, even if you account for dilution, I think today is gonna look cheap. Again, Tectonic is more of a higher risk, higher reward type play, but it's cheaper than all the other ones as well. But it's like, this flat gold project might be a legit large type system. So it's like, either it doesn't work out, or maybe I get a 20 bagger in this. Elora Resources, monster system, keep hitting, cheap based on what they have. Going to be a maiden resource out in the not too distant future. Who knows, maybe a PEA, maybe they get bought, whatever. It's just cheap based on what they have. They added more land. There's upside surprise there. Brixton Metals, like a bunch of projects. BHP as a partner. They have X amount of projects which might work. I mean if the Camp Creek project, which got BHP interested, okay, they're not interested in anything less than 2 billion, I would say, potential. I mean, that might be a huge company maker. Trapper might become a company maker. Metla might become a company maker. They have much more targets than that. They have their Langis silver cobalt play. It's like, are any of those guaranteed company makers? No, but you get 3-4 shots, for example, just based on what they know, and they have more targets than that. So it's diversified to the upside. And you have BHP as giving thumbs up already. And at the current market cap, I mean, it's not even close to what BHP would be happy with at the end of the day. Montage Gold, ex-Redback team. Superb management team. I mean, the last 2 gold juniors they basically ran, both of them were sold at all-time highs. At least from the start of when they got into it. Orca Gold got sold in Sudan. I mean, to sell a project in Sudan, that is, abnormal or very impressive, let's say. And Redback Mining, which was one of the biggest success stories in 2011, it got sold for $9 billion. I mean, people still talk about that. So, I mean, and the funny thing, I'm writing a piece on them right now, just to show, the value management team. If you bought Redback Mining or Orca Gold at any point in time when this management team was at the helm, regardless of when you bought it, high or low, short term, you would have ended up making money on every single buy if you just held it long enough. Which jives with the fact that this is a team that creates value. So the longer you hold the stock, the more value will have been created. So if you buy a short-term top, that means you have to wait longer for it to show a profit, let's say, based on those 2 earlier stories. So you get bailed out by the fact that you have a great management team, and the only thing you could do, or the only way to capture that, is to hold the stock as long as possible, let's say, as long as they create value, and buy the dips. I mean, perfect HODL case. It's in Africa, so I mean, some people don't like Africa. Some say Africa is the best jurisdiction because you can actually build mines. Pacific Ridge, ton of projects, 2 discoveries pretty much. Is that pricing in, legit gold, copper mine or 2? No, I don't think so. So again, it's that might not work out, or it might work out. If it works out, yeah, 10-bagger wouldn't be out of the question, I think. So in that case, it's hey, if there's a 10% chance of that happening, that's still a good risk reward, or okay risk reward. If it's even higher than that, or the payday would be even bigger than whatever the market cap is going to be, I don't know, 450 million if they 10-bag. Again, it's no guarantees for any of these. But my base case is that some might turn out very well. Some already have so much. I mean, Magna Mining, for example, they don't even need a new catalyst. I mean, they are cheap just based on what is already there, and that's why I love Magna. And yeah, again, this HODL portfolio, I do maybe a few transactions every month. I mean, the latest addition would be Mawson Gold and Montage within the last month. And I had to shave some of these other holdings. Not that I'm bearish on them, it's just that, hey, I mean, other but let's say, okay, it's so, let's say, good that, I have to shave some. But and this is kind of concentrated, actually, or it has become. But it's my weighting in Magna is kind of, I think, the largest by far still. And okay, this is my aggressive concentrated portfolio, and this is one that I'm more, let's say a trader in, because this is just a subset of my overall portfolio. I can't obviously trade the private placements if I'm in a holding period or whatever. But this is with money that I can buy or sell on any given day. And obviously, from a 3-year perspective, there's quite a big difference from the HODL portfolio, which still kicked the ass of GDXJ by simply just holding and letting these companies create value, etc. And again, it's like I'm very, very, very happy with this return. But a lot comes down to, again, it's like your position sizing. And that's something I think I've become even better at, let's say. And this is my aggressive portfolio. And if I showed, let's say, if I showed, let's say somebody says, hey, I want to have results like this, and I wouldn't be this aggressive with my entire portfolio, first of all. So this is like skewed in that sense. I think this makes up maybe 30% of my overall portfolio. But it's like, take some of these examples that, I mean, if I have a super high conviction case, this portfolio might be, I mean literally, I think because I couldn't buy, for example, Snowline Gold in any other portfolio than this, because my broker wouldn't allow my my company portfolio to buy Snowline. And I was so excited about Snowline. I did a bunch of K-Report interviews, and I put out a piece, etc. So I wanted a big exposure to Snowline. So this portfolio almost was all in Snowline, and that is basically this repair. Fast forward a few months, Snowline was still like the top pick, I would say. But then I found Magna Mining, which from a margin of safety perspective looked even better. So now this portfolio is, Magna Mining is still the top pick, or the highest weighting by far, because I think that's super cheap. But again, this is not a fair representation of what my overall portfolio is. So that would also, I don't think that would help people. It's like, oh, he's 60% in one stock. I'm gonna go 60% in one stock too, because I can't guarantee that Magna will work. I can't guarantee that Snowline will be a tier 1 deposit. So I don't think that's helpful either, really. I think it's more helpful to, perhaps press on like HODL cases, because, I mean, most of these, I think, you're gonna kick. If I just had these 10, I would think that this portfolio, without doing anything at all, I think that is gonna kick the ass of GDXJ next 2 years. If I did no trade whatsoever. So that is, I think, like the best help or gift I can give people. Is like, again, think about what is actually helpful, because this is like way too aggressive for most people, and this can change on a I mean, if I find a company that I think is even better risk reward than Magna, for example, then I might sell Magna. I have so far not yet been able to do so, but it's like, but that wouldn't mean, let's say Magna becomes the second highest conviction pick, and I find something new. I mean, all of a sudden it's like, oh, he's bearish on Magna, or that I had to sell some other stock to buy a new conviction pick, whatever. I mean, that's why, again, it's like I don't talk too much about waiting or selling or typically not even buying, because that you have to do that yourselves, and I don't think that is I don't think I'm giving any benefit doing that. Because again, it's like if I use my overall portfolio, there's going to be a bunch of private placement positions which I wouldn't have as that high of a weighting, let's say, if I didn't get the warrants. And if you don't get the warrants, our cases, our risk reward are completely different because mine are skewed by private placement warrants. And if I use the one I manage more actively, that's also going to be skewed because this is a subset of my overall portfolio, and I wouldn't take this much risk or be this concentrated if this was my entire portfolio. So I can't really, none of my total portfolio nor my aggressive portfolio does not translate to anyone else's total portfolio who doesn't have warrants, and most people do not have warrants or can be in private placements. So again, I think I would be doing a disservice. But I let's say like I wrote when I wrote up Magna Mining, it's a significant position for me. So you get a sense, okay, right then and there, what my conviction is. Then it's up to everyone to, if they are interested in buying the stock, understand the case, actually see the case, then it's up to every one of you to, have the position size that you are comfortable with. Because it's not easy. It's like my position size in Magna is quite absurd. So it's very, very, let's say, stressful. But I just remind myself, like, okay, this is super cheap still. But of course, eventually it's like, yeah, okay, if this goes 50% higher, I mean and I believe it will. It's like I have to take profits in that case, because it's like it would be such an absurdly large position that it might actually become quite hard to sleep. But at the same time, I think there's an edge in being able to have a very large position in a very high conviction case, instead of like saying a flat, I only want to have max 3% in any particular story. It's like, I think that would be a waste. If you find, some superb risk reward case and you only limit that to 3%, and you have like your 10th best case at 3% as well, I think you're shooting yourself in the foot. Some cases are like 1,000% better than other cases, so I think they should have considerably more weighting to them than others. But everything changes. Depending on news and price. I mean, if Magna Mining went up 200% tomorrow, obviously the risk reward changed a lot, so the opportunity would be gone in that case. But that's basically it. It's like we're waiting for the big move. That's what I'm waiting for. That's why I have myself strapped to the share. I'm not selling any. I'm net long. Yes, depending on what opportunities I see. It's like, again, I picked up some more Western Alaska when it dipped to 2.56 just a week ago. To me that's absurdly cheap. So I had to sell some other stock that hadn't gone down. That's value shuffling, and now it's up at 3 point whatever. But I didn't buy Western Alaska because I think it was going to go up the next day, because it had broken a trend line. So no shortist or trader would buy that. I bought it because I think these levels are going to look absurd in 2 years. So if a high quality stock goes down 30%, let's say, for no real reason except volatility and emotions, maybe the risk reward got 200% better. So instead of selling like everyone else because you're guessing, hey, it's going to go down tomorrow, I was like, having my mind set on, hey, what is this probably going to be worth in 2 years? And then, I buy that. And that might not turn out to be true, but at least I paid 30% less, let's say. So there's a 30% less risk that I'm actually overpaying for it. And if it works out the way, I'm going to make even more money. A super long rant. I think some of this made sense. And again, this is not investing advice. Consider me biased. I probably own shares of all companies I mentioned. Some are banner sponsors as well. Again, twice biased. And it's like, again, never buy just based on what I buy or own or whatever. It's like, again, it's like I might be super bullish on a stock, and then I find a better stock. Maybe I'm selling the stock I just became super bullish on because I found another. So it's like, but that, still doesn't mean, a top pick might become the second top pick, and I have to sell the second top pick to buy the, an even better pick, in my opinion. So it's like, assume I might sell or buy any of this company at any point in time. And we don't share profits or losses. So again, it's like the most important thing is that you have conviction and know what your game plan is. Because otherwise you don't even have a strategy, and then you're never gonna. And to me, again, it's like the in my opinion, most important thing to keep in mind at all times are that I think we're gonna go up here. I'm not saying Bear Creek Mine is gonna go up here. I have no idea if Bear Creek Mine is even gonna be around, but the whole sector is not gonna go away. So this again, short is I think the most important thing, and that tells me I should be long until we get up here in sentiment levels. And some units will not work out, some will work out great. But on the whole, I think we're gonna have some multi-baggers, maybe some 10-baggers, within 2 years. And that means that certainly not all of our companies need to work out. As you know, I've taken heavy losses in White Rock, Novo, Mantero's, they're called Mantero Precious Metals right now. And that needs to be offset by winners. And to have big winners, you have to hold them over a long time period. There are very, very few 10-baggers that happen in less than 2-3 years. So if you actually want to have a 10-bagger that could pay for 10 other companies going to zero, you typically need to hold that stock for 2-3 years. And if you have a long-term case, it makes no sense to be a short-term trader, because then the buy and sell doesn't add up. And again, that's why, for some of these, in my opinion, pretty good HODL cases, makes no sense to be a short-term trader if you have a superior management team or a super good growth pipeline. The only way to capture that is to give it a lot of time. And again, it's like this very low maintenance portfolio still kicks GDXJ's ass. And this has nothing to do with trying to predict when the tops are going to come or the bottoms are going to come. And you see these huge correction, flat line, let's say, corrections all the way up. Correction, big correction, and a long big correction. Then all of a sudden it goes up, and then a correction again. So it's like, this is more volatile than it looks, but it's just that in time, as you can see, the trend is still up, and now it hit a new all-time high. So that it's gonna probably go something like this all the way up to we hit this point. And then it's like, okay, then we'll have to decide what are we gonna do. Probably get rid of all the beta at least. Sure, we might go to this level here, but that's not, in this example, yes, that is actually, let's say 100% return, but the big gains are made from here to here. This is no time to be cute. I don't think this is a time to be cute, not even this or this, and we'll be happy anyways. Like, yeah, or if the market averages 8% per year, what do you think this move is gonna, how many years worth of gains are we gonna get just from, the next 2 years? Maybe, I mean, from this level, maybe we, who knows, let's say we get 400% or whatever. I mean, that you should be content with that for X amount of years going forward with no returns. So keep that in mind. It's like, again, no stock goes up forever, because like recently you see a stock go up 20%, 30% in 2 weeks, or let's say 40% in 2 weeks, and then it goes down like 20%, and everybody's like all of a sudden, oh Jesus, I mean, now it's falling again. But it's like, think about it. If that would compound at 40% every 2 weeks, that would be up, who knows, 30,000% in a year. So I mean, you can't ask for that. That's how this sector works. I mean, yeah, let's say it goes up 40%, down 20%, up 25%, down 15%, up. I mean, at the end of the day, you will have a good return. It's just you're going to get a lot of 30% corrections and maybe 50% corrections blended with the 50 to 100% runs, etc. Like, again, you see here. On a 3-year time period, you can see a trend. On a 1 year or a 1 month or 2 months or 3 months time period, I mean, this is a declining trend. This is a big uptrend. But it's just that, okay, enough time, yes, this is, a slow and steady rise. And that has created, really good returns at the end of the day. Obviously, that didn't look so great down here. But I knew, I mean, I knew that things are going to change. I've seen this like 4 times before. Yeah, anyway, it's like probably a super long rant. Hopefully you got something out of that. And it's like, good luck out there and stay rational. It's like all you see is noise pretty much on a constant basis. So in my opinion, again, stick to what are you paying for a company today? What do you think it's going to be worth in 2 years? That doesn't even factor in the sentiment swing. But also, keep this in mind as well, I would say. So again, stock picking, what price am I paying for a company today? What do I think it's going to be worth in, let's say, 1, 2, 3 years? If you think it's cheap right now, that's probably a buy. You don't even need to be right on every company, far from it. And keep in mind that the sentiment swing alone, when a trend starts to form, that's just going to feed on itself. So you're probably going to get, again, like 200-300% on average just from the sentiment. And then you get the value creation as well. So again, it's like 200-300% from sentiment. Let's say a company has increased 200% in value. So that's a multiplier on itself. That's how you can make really, really good returns. So you can actually suffer these extreme crashes like we're seeing right now. And again, lastly, remember, we're still in tax loss selling season. So if you see heavy volume crashes right now, that's probably got little to do with the actual company. That is just someone crashing price because they put in a market sell order, because the whole point of selling was that they had a loss already, and then they don't care how big the loss really is because they're just going to use it for tax reasons. So don't try to see ghosts around every corner just because in this month of December you see heavy volume crashes. That might be the best buys you're going to see in the next 8 years. I'm just saying. Thanks for listening. Hit the thumbs up button if you like this stuff. Bye.